Good afternoon, everyone, and welcome to the July 2020 RSM VAT webinar. Over the next hour, we'll be giving you an update on the most important VAT developments that have appeared during the last 2 months. Your presenters today are Pete Williams and Steve Hodgetts, who are VAT partners based in our Birmingham office, and me, Sarah Halstead, RSM's National Technical Officer for VAT. If you'd like to ask us a question during the webinar, then please type it into the Q&A box at the bottom right of your screen. If you can't see a Q&A box, then click on the 3 dots button at the bottom of the screen and then click on the Q&A icon. We'll answer questions towards the end of the presentation in our Q&A segment, or we'll pick them up with you by email afterwards. Today's webinar is going to be recorded, and we will send out the recording and a copy of the slides to you by mail in the next day or two. Let's have a look at today's agenda. First on the list is the temporary reduced VAT rate of 5%, which will apply to hospitality, holiday accommodation and to shows and attractions until the 12th of January 2021, along with a quick word on the VAT implications of the government's Eat Out to Help Out discount scheme for restaurants and pubs. We'll also bring you up to speed with the government's plan for the border with the EU after the Brexit transition period ends on the 1st of January 2021. Then we'll cover some recent VAT cases from the First Tier Tribunal, and we'll finish up with our guest speaker, Steve Hodgetts, who has some news for charities on the VAT position of digital advertising, before finally moving on to your questions. So I'll now hand over to Pete Williams to talk about the new reduced VAT rates. So over to you, Pete.
Good afternoon, everybody. Welcome to today's seminar. Countries around the world have been turning to emergency VAT deferrals and VAT rate cuts. So it wasn't completely surprising, perhaps, when the Chancellor Rishi Sunak made an announcement on the 8th of July 2020, allowing VAT registered businesses to apply a temporary 5% reduced rate of VAT to boost the hospitality and tourism sector, one of the worst hit sectors of the UK's economy following the lockdown. The 5% rate will apply to supplies that are made between the 15th of July 2020 and midnight on the 12th of January 2021. And the best way to look at the changes is to split them into 3 categories as shown on the slide. Firstly, hospitality, which is basically food and drink sales in pubs, cafes, restaurants, members clubs, fast food takeaways. The reduced rate will apply to supplies of food and non-alcoholic beverages for consumption on premises, and also hot takeaway food and hot non-alcoholic beverages. Secondly, hotel and holiday accommodation, all overnight accommodation in hotels and similar establishments and suppliers of holiday accommodation in caravan parks, campsites and holiday cottages will all benefit from the temporary VAT rate. And thirdly, admission fees to visitor attractions. The Chancellor's speech referred to cinemas, parks and zoos, but the 5% rate will apply far more widely than that. But it does not crucially apply to sporting events, and it also won't apply where an attraction already benefits from the cultural exemption. Just flick on to the next slide. In each of the 3 different categories, there are also some important points to note. In respect of hospitality, all on-premises sales are now reduced to 5%, apart from alcoholic drinks. All sales of alcohol remain at 20% VAT, but cold takeaway food retains its current VAT treatment. This is undoubtedly going to cause some complexities because certain cold takeaway foods are zero rated, such as salads and sandwiches, and some are standard rated, such as confectionery and crisps. It will also lead to some rather odd consequences, such as a packet of crisps sold to a diner in a cafe will be at 5% VAT, but when it's taken off premises, it will be liable to 20% VAT. Similarly, a can of Coke sold for consumption on the premises will be at 5%, but taken away to consume off the premises will be at 20%. This also means that till systems in a lot of establishments are going to have to dealing with 3 different rates of VAT for the first time. In respect of holiday accommodation, the reduced VAT rate is more straightforward. But one of the key issues relates to tax points, and particularly payments in respect of advanced bookings before the reduced rate took effect, but the customer's stay is after the change of the VAT rate. The good news here is that there are some very helpful change of VAT rate provisions that businesses may apply when the VAT rate reduces. These provisions mean the supplier has the option of applying the basic tax point when the service is actually performed or the dates of the actual booking for the entire supply, even though part or full payment may have been received and a VAT invoice was issued before the rate change at the old VAT rate. In respect of admissions to tourist attractions, any goods that are incidental to the main supply may also be at the 5% rate. But one of the main points to note about the new VAT rate for admissions to attractions is that tickets for concerts and events sold at 20% before the rate change will still be at 20% even where the performance of the event is during the period in which the 5% rate applies. This is because HMRC's view is that the sale of a ticket is the sale of a right to attend, and that right is granted or performed when the ticket is sold, not when the event itself takes place. So if a customer purchased a ticket to see Elton John in June 2020 for a concert in December 2020, the tax point would be the earlier of those dates, and that would still be due at 20%. But it also means if you bought a ticket to see an Elton John concert today, it will be at 5% VAT, even if the concert is performed in summer 2021, after the VAT rate is back to 20%. And just flick on to the next slide, please. As with all changes to the UK's tax system, what at first appears to be relatively straightforward can turn out to be anything but, and there are a wide variety of technical issues that are already resulting from the rate change. These include how mixed suppliers are treated, where a good or service with two or more different rates is sold for a single price. Suppliers need to decide if there is one single supply subject to a single price and a single VAT rate, or a mixed supply that needs to be apportioned between the different rates. A gin and tonic sold in a bar seems to be the most cited example of this in the last few weeks, but there are countless other examples. There has been a carve-out for catering services for consumption off a supplier's premises. These services remain at 20% and so don't benefit from the reduced rate. Car parking has cropped up as an issue as some tourist attractions are free entry but make a charge for parking instead. So we've been asked if the parking qualifies for the 5% rate, and the answer to this has to be no. A separate and distinct supply of car parking will not be covered by the reduced rate, but an admission charge that includes parking will be at 5%. There's an impact on the tour operator's margin scheme, as the reduced rate does not apply to the margin scheme calculated under TOMS. That will remain standard rated if they are EU suppliers. But obviously, if you're buying in suppliers under TOMS at the 5% rate, this is going to effectively increase your margin and increase the amount of output tax due in the TOMS calculation. If you supply gift cards and gift vouchers, and there are issues arising depending on whether the voucher or gift card is a single-purpose voucher or a multi-purpose voucher. Multi-purpose vouchers that are redeemed for supplies impacted by the reduced rate during the period of the rate change should be treated in the same way as cash and VAT accounted for at 5%. Vending machines are also impacted by the rate change, meaning suppliers of food and drink from machines sited in canteens and restaurant-type areas will qualify for the temporary reduced rate as supplies to be consumed on the premises where they have been supplied. All supplies from machines sited in thoroughfares and areas not designated for the consumption of food will follow the liability of the product being sold. Agent selling commissions. If you're an agent selling tickets on behalf of an event promoter, then your selling commission is still going to be at 20%, even if the tickets themselves qualify for the 5% rate. We've already seen examples of this creating real commercial tension where promoters have passed on the VAT rate cut and the agent's selling commission is being calculated on the VAT-inclusive selling price of the tickets. Just flick on to the next slide, please. There are also lots of practical issues arising from the rate change, and some of these are listed on this slide. I'll just pick out a couple of things from this list. Firstly, there are obviously pricing decisions for suppliers. Businesses will need to decide whether to pass the reduction on to the consumer or hold prices and keep the benefit. But the decision is a commercial one, and there's no legal obligation to pass the VAT rate cut on. Secondly, there were no anti-forestalling measures announced by HMRC to prevent advance payments being made or invoices raised before the 12th of January next year for a supply that relates to a period after this date, when the 20% rate applies again. The reason for this is that HMRC want the basic tax point rules to continue to apply for prepaid bookings the hospitality and leisure sectors receive before the 12th of January, but that take place after the 12th of January. HMRC say this will help businesses in the sector and support employment as lockdown restrictions are lifted. I'll now hand over to my colleague Steve, who's going to just say a few words about the Chancellors Eat Out to Help Out scheme.
Good afternoon, everyone. This scheme only applies for the month of August. Caterers can now register on the HMRC website. Diners can only take advantage of the scheme for a Monday, Tuesday or Wednesday. So the first day the scheme is available is next Monday. A maximum of 50% discount eating out at a restaurant can be given to a maximum of £10 per diner. A diner may attend as many times as he likes during the month of August. There's no discount on alcohol or service charges, so those must remain. Who does it apply to? Restaurants, pubs, work and school canteens, food halls. A claim cannot be made by the catering establishment until the caterer is registered on the HMRC website. The earliest a claim can be made is the 7th of August. You can only make a claim for scheme discounts you offer on or after the date you register. You can make a claim up to five times before the 30th of September. You cannot claim after the 30th of September. You must have a record of the total number of diners who have used the scheme discount in your establishment. You must have a record of the total value of all eat-in food and non-alcoholic drink sold where the scheme discounts were given. You must have a total value of scheme discounts you've given and claimed for. If you are using the scheme for more than one establishment, you must keep separate records for each. Importantly, you'll still need to pay VAT based on the full amount of your customer's bill before the scheme discount is applied. This amount needs to be reflected in the current VAT return for the period the transaction took place. This could create a cash flow difficulty given that you may not have been compensated for the £10 that you're paying the VAT on. If your point of sale system does not allow you to account for VAT accurately under this scheme, you can manually adjust your VAT account after the sale. If you cannot include the adjustment in the period the transaction took place, you should estimate the VAT and you must account for any difference on the next VAT return. Further guidance on these issues and how to claim will be issued by HMRC before the 7th of August. I should just add that if you do offer your own discounts as an incentive for diners to return, clearly VAT is only due on the discounted amount, not the gross amount before the discount. I now pass you back to Peter.
Thanks, Steve. So after a few months of not being in the headlines due to COVID-19, Brexit is back with a vengeance, as the UK has confirmed that it will not be extending the Brexit transition period after the 1st of January 2021. This means the UK will be leaving the single market and customs union on the 1st of January next year, and that there will be controls in place for the movement of goods between GB and the EU, and most probably between GB and Northern Ireland as well. So regardless of whether or not the UK gets the deal it wants agreed with the EU before the 31st of December, businesses are going to have to start preparing now for the reality of customs checks and having to fill in declarations when moving goods between Britain and the EU. This will apply to everything from massive shipments of goods to FedEx packages. So are UK businesses ready? Well, a recent Institute of Directors survey stated that only 1 in 4 firms are ready for the end of the transition period, with the majority, 70% of directors surveyed, saying that securing a deal with the EU rather than crashing out on WTO terms was crucial for their business. Just flick on to the next slide. So with under 6 months until the transition period ends, the government has published its plans for how cross-border trade will operate with the European Union after the end of the transition period in a 206-page document. So how's the border going to work from the 1st of January? The first thing to say is that the new post-Brexit border will not be fully operational until July 2021. And the government has said businesses trading most standard goods, covering everything from clothes to electronics, will not have to submit customs declarations for the first 6 months of next year. Instead, they will have to keep internal records so that they can submit their declarations, plus pay any tariffs they've accumulated by the end of that 6-month period. That in itself means businesses will have to build up their expertise in making customs declarations from January. Many businesses may also decide not to take advantage of deferred tariff payment so that the costs don't pile up. This staged approach, it is hoped, will allow businesses to make a record in their own commercial records at the point of entry of goods into GB, and then follow this with a supplementary declaration which must be submitted to HMRC within 6 months of the point of import. Crucially, the 6-month grace period only applies on the UK side, as the UK can only decide what happens at its own border. The EU has not indicated yet whether it will reciprocate. Standard customs declarations will be needed from 1st of January for controlled goods and excise goods like alcohol and tobacco products. There will also be physical checks at the point of destination or other approved premises on all high-risk live animals and plants, and a requirement to pre-notify certain movements of other goods. The government is also building a new IT system called the Goods Vehicle Movement Service, which will allow businesses to declare their shipments electronically. The idea is that by requiring all the paperwork to be done in advance, trucks will have been pre-approved before they arrive at Dover, making the process relatively smooth. There are also plans to build 10 to 12 inspection sites in different parts of the country to check trucks of documents all in order before they reach the port. From April 2021, all products of animal origin and all regulated plants and plant products will require pre-notification and the relevant customs documentation. Any physical checks will continue to be conducted at the point of destination until July 2021. However, from July 2021, traders moving any goods will have to make full customs declarations at the point of importation and pay the relevant tariffs. The Goods Vehicle Movement Service will be in place for all imports, exports and transit movements at border locations which have chosen to introduce it. And just flick on to the next slide, please. So between now and the end of the year, both the government and businesses are going to be more and more consumed with Brexit. There have already been several publications in the last few weeks released on HMRC's website on how to make customs declarations and defer tariff payments under the new border operating model. Only yesterday, HMRC confirmed that from the 1st of January 2021, if your business is registered for VAT in the UK, you'll be able to account for import VAT on your VAT return for goods imported from anywhere in the world. This means businesses will declare and recover import VAT on the same VAT return rather than having to pay it up front and recover it later. Crucially, if you're eligible to defer submitting your supplementary customs declarations for up to 6 months as previously discussed, then you must account for import VAT on your VAT return using postponed VAT accounting. The only businesses that won't be eligible will be those businesses authorised to use simplified declarations for imports and that have completed a simplified frontier declaration before the 1st of January 2021. HMRC has also now published additional guidance on the treatment of low-value consignments from the 1st of January 2021. That will be collected at the point of sale rather than on importation for consignments worth up to £135. Customs declarations will still be required on imports, although these will be simplified. Intrastat declarations, there's going to be no escape from them. These will still be required after January 2021. Amazon sellers who use Amazon's Fulfilled by Amazon or FBA service were also given a Brexit bombshell last week when Amazon wrote to them and said that their UK fulfilment centres will not be used to fulfil orders to customers on mainland Europe after the 1st of January 2021, effectively reducing UK FBA sellers' customer base from 446 million EU consumers to 66 million Britons, and meaning that British FBA sellers will now need to hold stock in the EU if they want to use Amazon's FBA service to reach EU customers. Finally, please remember that the new border operating model that has been published will only apply to trade between Great Britain and the EU, so it won't include how arrangements between GB and Northern Ireland are going to work. The government has promised more information on how things will work in Northern Ireland by the end of this month, so we'll all be looking out for this in the next few days. So preparing for the 1st of January, what actions should businesses that import and export from the EU be taking now? Firstly, apply to HMRC for an EORI number. It was clear from yesterday's announcement that HMRC that you're not going to be able to benefit from postponed import VAT accounting without an EORI number. Secondly, unless you're able to train staff up internally in the next 6 months to complete customs declarations, then you should be exploring appointing a customs agent or customs intermediary. There are, however, grant schemes available for businesses wishing to make customs declarations themselves. Thirdly, apply for a duty deferment account. This enables customs and duty charges to be deferred. They won't be needed for VAT in most cases due to the introduction of postponed VAT accounting, as just discussed. But there will also be new rules around, there's also going to be some new rules introduced by HMRC to allow most businesses to use duty deferment without a customs comprehensive guarantee after January 2021. Which will certainly be worth exploring for those businesses that currently have expensive bank guarantees. Fourthly, the UK's new global tariff has already been published, replacing the EU's common external tariff. So businesses can now go online and check what tariffs will apply to their goods from 1st of January 2021. Fifthly, businesses should explore what customs regimes and simplifications are available to make life easier for them and keep customs costs to a minimum. For example, the Common Transit Convention, simplified declarations, and the new Goods Vehicle Movement Service, as well as other processing reliefs, such as authorised economic operator status. And finally, businesses need to consider their existing commercial contracts with EU suppliers and customers, as existing arrangements may change. For instance, are your EU suppliers going to change their Incoterms from DDP to DAP? There are also going to be VAT law changes in some specific sectors, such as for tour operators and in financial services. How are these going to impact your business if you're in those sectors? Some existing VAT simplifications are also going to disappear, such as for transactions involving triangulation, distance sales, supply and install simplifications, call-off stock arrangements, and there might also be additional VAT registration and reporting requirements. Will your existing EU VAT registrations require a fiscal representative after the 1st of January? Now is the time to start preparing for these changes, not in December. And finally, according to HMRC, figures from 2018, filling in a customs declaration will cost the average UK business £32.50. As British companies are expected to have to fill in 215 million extra customs declarations a year, with an equivalent number of EU ones, the overall price tag for UK businesses is expected to be around £13 billion. But as the former Deputy US Attorney General Paul McNulty said, if you think compliance is expensive, then try non-compliance. And I'll now hand you over back to Sarah.
Thank you, Pete. Okay, now it's time for our VAT case law update, and we've picked out two cases this time, both of which come from the First Tier Tax Tribunal. Firstly, we're going to look at the main pay case on the VAT position of temporary staff. Although it's about the NHS and healthcare, there are some lessons here for hirers and providers of temporary staff in other sectors too. We also have the Europe car case, which looks at the VAT position of additional charges for optional extras when hiring a car, in this case for a child's car seat. Is it a supply in its own right, or is it just part of the overall car hire? Let's start with main pay. Now, main pay is an employment business that supplied locum consultants to work in A&E departments of NHS hospitals. And a dispute came up with HMRC over whether this was a supply of medical care, which is exempt from VAT, or a supply of staff that was subject to VAT at 20%. The appeal in the tribunal focused on the key test of whether the consultants were under the control, direction and supervision of Main Pay, the company that placed them, or of the NHS trusts with whom they were placed. And the tribunal decided that the supply of the locum consultants did not qualify for exemption as a supply of medical care. It was instead liable to VAT as a supply of staff. This was a particularly tricky question because locum consultants operate differently from most temporary staff, because as doctors, it's them and not the employer who has control over the clinical decisions that they make during the course of their work. And in this scenario, the tribunal thought that operational control over where and what work the consultant carries out was decisive. The consultants provided by Main Pay carried out their work in the same way as a consultant who was employed directly by the NHS Trust. Therefore, Main Pay had supplied staff for the NHS to use and not medical services. So why does this matter? Well, until around 10 years ago, there were various concessions in place under which temporary staff could be hired without paying VAT on the full cost. These have now mostly been removed, leaving many VAT-exempt sectors suffering irrecoverable VAT on staff costs. Some employment businesses or care providers operating in the healthcare sector have responded with new contractual relationships, and these try to argue that instead of simply providing staff, they've used those medical professionals to supply a VAT-exempt medical service to the end provider. HMRC regularly challenges these arrangements, and a few have made it as far as the tribunal. Sometimes HMRC wins, sometimes it loses. It really depends on the precise arrangements in place. We've seen a couple of businesses actually win their case because they've argued that they've set up a separate practice within the organisation to which the staff have been sent to. But really, the small print in the contracts is what's crucial here. Also, there's a lot of organisations in the healthcare sector and beyond whose VAT accounting on temporary staff hasn't really kept up with the changes over the years, and they could be at risk of retrospective VAT bills. So the message here is, whether you're in the healthcare sector or any other sector, it's important to review your contracts and your VAT accounting on temporary staff in the light of the current rules and the latest case law. Let's move on to look at the Europe car case. As most parents will be all too aware, child car seats and booster seats are a legal requirement for children travelling by car when they're under 12 years old or under 135 centimetres in height. And since 2001, sales of child car seats have been eligible for the reduced rate of VAT of 5%. This was looked at in detail in a dispute between HMRC and car hire business Europcar over the correct VAT treatment of the fees for hiring a child car seat to customers when they hired a car. Europcar believed it had made two separate supplies, one of the hire of the vehicle, which was subject to VAT at 20%, and another of the hire of the child car seat, which was eligible for the reduced VAT rate of 5%. But HMRC disagreed. Their view was that the inclusion of the car seat in the package was merely ancillary to the main supply of a hire car. So the fee for the car hire and the fee for the child seat hire amounted to a single supply of a hire car and was entirely subject to VAT at 20%. But the tribunal has actually found in favour of Europcar, deciding that the hire of the car and the hire of the car seat were two separate supplies. So Europcar was entitled to apply the 5% VAT rate to the child seat hire fee. Okay, so let's have a look at the tribunal's reasoning behind this. The tribunal thought that the two supplies were economically distinct. It was clearly shown in the booking process that hiring a car seat is an optional extra for an additional fee. And the costs of car hire and the car seat hire were itemised separately throughout. Also, the tribunal thought that hiring the seat was an essential aim for the customer rather than just a means of better enjoying the car. They needed the seat to legally and safely transport the children. Europcar told the tribunal that only around 1% of their car hire customers would actually hire a child car seat when hiring a car. Most customers with young children already had one, so they'd simply use their own. The cost of the seat hire was relatively expensive. It actually cost as much to hire one for 3 days as it would cost to buy a new one. So most customers who hired the seats did so for convenience because they were travelling to the pickup location by train or by air, making it difficult to bring their own. So the tribunal found that a customer travelling with young children had realistic alternatives to hiring a car seat from Europcar. They could bring their own seat or they could buy one locally. This also supported the conclusion that the car seat was a supply of services in its own right and not just part of the car hire. So why does this matter? Well, firstly, it highlights complexities of VAT for car hire businesses, which usually make a variety of additional supplies and charges to customers when hiring a car, like breakdown cover, collision damage waiver, fees for collecting fines or congestion charges incurred by the customer. There's a real array of these. I'm sure we're all used to seeing if we hire a car. Not only must hire car companies determine the VAT liability of each charge, they've also got to consider whether the fee is paid for an independent supply or whether it's just part of the VATable supply of car hire. Also, if you look beyond the car hire sector, the appeal is another example of HMRC challenging the use of VAT reliefs by arguing that a supply that would normally be eligible for a lower VAT rate or even no VAT at all is actually part of a larger supply that's subject to the VAT at the standard rate of 20%. In this case, using a child's car seat is actually required by safety laws, which is the very reason why the seats are eligible for the reduced VAT rate in the first place. So HMRC's stance in the Europcar appeal is unlikely to go down too well with parents. But there could also be implications for other businesses who hire safety equipment like protective helmets in the course of their activities. And it's always something to think about if your business makes any extra charges on top of the charge for its core product. Is it for a supply in its own right and subject to its own VAT rate, or is it just part of your main supply? So HMRC has yet to comment on whether it will appeal the Europcar decision, but either way, this will not be the end of the story for these broader VAT issues. So I'm now going to hand over to our guest speaker, Steve Hodgetts, who has some news for charities about digital advertising. So over to you, Steve.
Thank you, Sarah. Yes, this is a session specifically for charities on VAT and digital advertising. It is particularly topical at the moment. There's been much comment in various areas recently in respect of HMRC's position on digital advertising. So as a reminder then, the provision of advertising to charities has been zero rated for many years. The relief is very wide. It applies to any type of advertising on any medium. So advertising in a magazine, newspaper, TV, radio, advertising hoarding, side of a van, another person's website qualifies for the zero rate. The supply also includes services of design or production of any advertisement. It does not include a supply where any of the members of the public, whether individuals or other persons who are reached through the medium, are selected by or on behalf of the charity. Now, the words in italics on the slide are the words from the legislation. For this purpose, selected includes selected by address, whether postal address or telephone number, email address or other address for electronic communication purposes or at random. Next slide, please. So the original drafting of the legislation was specifically targeted at things like direct marketing to individuals. But as a reminder, the VAT zero rating was written before social media, and the restriction was targeted, as I say, at direct mail shots to potential supporters of the charity. The guidance says supplies which qualify for relief include such things as printing, design, artwork, typesetting. As I say, it's quite wide, and as I said, it does not include distribution and mailing services. Next slide, please. The problem has arisen because HMRC say advertising must be communicated to the public to qualify for VAT relief. Advertisements in specific trade or religious magazines qualify for relief. So specific targeting of that nature is fine. HMRC say public does not include individuals selected by home, business or email. So social media software is used to track a selected audience through cookies, etc. And HMRC say this does not qualify for VAT relief. So this is a potential cost for many charities. We do expect to see further litigation in respect of this, as the Charity Tax Group is actively involved and has been in recent discussions with HMRC. Apparently, selection of an interest group is okay, but once there is a follow-up through directly to the consumer's computer, that in HMRC's view is specifically targeted, even though it's done automatically and based on the behavior of the consumer. Next slide, please. The sting in the tail with all of this is that many of these social media providers, such as Facebook and Google, are based outside of the UK. So under the VAT rules, charities must self-account for VAT on all advertising of this type under the reverse charge procedure. So essentially, VAT must be paid at 20% rather than the zero rate, and many charities cannot recover the 20% VAT. They are effectively charging themselves. What we suggest is that charities should consider their position, given the ongoing litigation, and take protective action by way of talking to suppliers about contracts and talking about protective claims, etc., should the litigation ultimately be favourable to charities. I'll hand you back to Sarah.
Thank you, Steve. Okay, so that's the last of today's presentations. Our next webinar will be held in October, and we'll confirm the exact date to you in due course. Also, if you'd like to receive VAT updates from RSM, you can join our VAT group on LinkedIn. Just search for RSM's VAT group. Now let's move on to look at some questions that have come in during the last hour. Pete, I have a question for you on Brexit. We've been asked, if I defer submitting my supplementary customs declaration for 6 months, when and how do I account for import VAT under postponed accounting?
Crikey, who's asked that? So, import VAT must be accounted for on the VAT return for the period in which the goods are imported. So that's even if you haven't yet submitted your final customs declaration, you've still got to account for import VAT under postponed accounting in the VAT return for the period in which the goods are imported. That was clear from yesterday's guidance that was published by HMRC. What it also says is that you should estimate the import VAT due from the records that you've kept during that first 6-month period. And then if, when you come to finalise your customs declaration, the import VAT amount turns out to be different, then you must make an adjustment in that later VAT period. As I say, that was the guidance yesterday that landed after we'd already completed our slides, of course, on this area is extremely useful. But that, looking at it now, that would be seen. Hopefully, that will answer the question, and the guidance is well worth a look at. Thanks, Sarah.
Okay, thank you, Pete. Peter, I have another one for you. This one is about the temporary VAT rate. As soft drinks are eligible for the 5% VAT rate, but alcohol is still subject to VAT at 20%. What happens with spirit mixers? What's the VAT position of something like a gin and tonic?
I could have guessed we'd get this one. So I think if a splash of tonic is added to the gin by the bar, then I would say that's a way of improving the taste of the drink. And it's probably, the single price is charged, even if there's just a little bit of more money charged for the splash, then it's still a single supply of an alcoholic drink, and it should all be subject to 20% VAT. But if a customer buys a gin and gets a separate mixer bottle of tonic, then I would argue that that's a mixed supply of two different products. The customer will usually add the tonic either at the bar or when they return to their seat. So I would say that the bar would be able to charge separately for and charge two different VAT rates. And I think, if the mixed supply outcome in that second situation wasn't correct, then customers could just simply order the two drinks separately, which would be a waste of everyone's time. So I think that has to be the correct answer for where a customer buys the gin and also a separate mixer bottle. It's got to be two separate supplies, two separate VAT rates.
Okay, I think that's an example of how the temporary reduced rate isn't as simple as it might seem at first.
Yeah, I mean, the rules have only been in a couple of weeks now, and we've had all sorts of weird and wonderful technical queries from clients, on things that you would never have envisaged or imagined when the rate cut was announced. The rules are, as with all changes, as I said earlier on the slides, they appear straightforward at the outset. When you actually get into the nitty-gritty, the nitty-gritty of the changes, and when the practical implications of them, it can get quite complicated. And I think the thing to remember is that, for businesses that are worried about how they apply the rules, is that, this is seen as a silver bullet to help an area of the economy that's been particularly badly affected. It's a temporary VAT rate cut, and I don't think HMRC are going to be, heavy-handed around how they police this. And there's aspects of it that they can't police either, and I think they're realistic. But it's a temporary VAT cut, the implications of which will, taxpayers will be dealing with for a long time, because HMRC can go back 4 years. But I really don't think HMRC will be heavy-handed with businesses on how they try and implement these rules.
Okay. Well, we're getting a lot of questions on the temporary VAT rate, and I think a lot of those are concerning people's views about some of the finer points of this, which hopefully HMRC aren't going to be too heavy-handed about. Another question we've had is, for the temporary reduced rate, does this only cover restaurants or cafes? What about food stores, farm shops that sell groceries, etc., but also have a hot food counter and coffee machine for takeaway food and drink?
That's a very good question. And my initial reaction, always take professional advice, but my initial reaction would be that, it's quite broadly drafted, the rules on the 5% rate. And I think, from the guidance that we've seen and from the revised legislation, I would think it would most probably apply in those situations, yeah.
Okay, thank you. I'm afraid another question that's for you, Pete, is about Brexit. Why will the UK still be required to submit interstate declarations? Surely the movements will be covered in customs declarations.
What HMRC have said is that certainly for the 6-month period after the transitional period comes to an end, interstate declarations will be required. And the reason for that is because at the moment, HMRC systems take information specifically from interstate declarations on in order to identify their balance of payments. They're not to do with tax; they're to do with movements of goods, what's coming in and out of the country. And without those statistics, the government can't determine what its balance of payments position is. So I think that they've announced they're definitely in place for the next 6 months. Whether they're going to be in place after that, they may or may not be, but they'll be replaced with something similar because, the government still needs that information. So I think those people that thought that sort of unnecessary administration, a red tape even, that was going to disappear after Brexit was going to go, then, unfortunately, it most likely won't do. But it may be replaced in the middle of next year with something simpler or something different, but the government will still need these statistics.
Okay, so we're hoping this is going to be a transitional measure.
We'll see, I think. They're certainly around for a bit longer yet.
Okay, right, we have another question. There's one for Steve this time on charity advertising. And the person who asked the question is asking how recent this case is, saying that he engaged with HMRC recently on charity advertising, and they agreed that VAT wasn't chargeable. But I think, Steve, the point is this is an upcoming case, is that correct?
That's right. There's been no litigation to date, only a letter from HMRC to the charity tax group on their policy in respect of social media advertising. So that the zero rating still applies to charity advertising. So in terms of the reverse charge, if it is not social media advertising, the reverse charge doesn't apply because it is a zero rated transaction. If it is social media advertising, where it's specifically targeted at individuals, as I've explained, that is not eligible for the zero rate. So the reverse charge does apply, and the taxpayer must account for VAT in full on his VAT return and recover an amount of VAT under their business, non-business method or partial exemption method. And in the charity sector, there's very often a restriction placed on that VAT recovery.
Okay, thank you. I've got another question for you, Steve, as well. This is on the Eat Out to Help Out scheme. The delegate just asks if you could run over the records which need to be kept for each establishment again. He's commenting that there seems to be a lot of record keeping required.
Right. Okay.
But we can answer that one by email later if you haven't got it.
Well, I think the main point is it's the business that registers on the HMRC website. That registration is available now. It is not the outlet that registers, but a separate record must be kept for each catering outlet that the business owns. So you must keep records for each establishment of the total number of diners, total value of all eat-in food and non-alcoholic drinks sold, and the total value of the scheme discounts you've given in claim for. So if you're a national caterer, you could have 400 or 500 separate records in respect of each outlet, but you'd only have one registration with HMRC.
Okay, right. Thank you, Steve. We've had another question about the temporary reduced rate, and this is asking, is it likely if there's going to be any extension of the reduced rate to other labour-intensive services, such as hairdressing, which might have been also affected by COVID-19? I'm guessing the answer to that, Pete, is that we haven't heard anything.
We haven't heard anything. And it was muted before Rishi Sunak announced the temporary 5% rate cut for tourism and hospitality sectors, whether there would be a wider VAT cut, to the 20% rate across the board, which would have helped everybody. But I think he concluded it was probably too expensive and probably too much of a blunt instrument. So whether it will change will depend on whether the temporary rate will be extended or introduced to other sectors. I guess will depend on whether we get this V-shaped recovery or not to the economy. I think if the economy does not improve by January next year, it's quite possible. It's quite possible, I'd have to say. I think to date the government has pulled as many levers as it can to protect businesses as much as it can and protect those sectors that have been hit worst. But surely, if the economy doesn't pick up towards the end of the year, then they may start looking at other measures and perhaps a full VAT rate cut. You never know. I wouldn't rule out anything or rule anything in. It's a possibility.
Yes, I think it's also important to add that even the existing reliefs that have come in, it was still kind of a movable feast, and we're getting more guidance coming in from HMRC every day. Although the initial announcement came out a few weeks ago, as recently as yesterday afternoon, we were getting more and more updates from HMRC. So this is something we need to keep an eye on in the coming weeks. Okay, I'll just look for another question for you. Pete, this is another one for you. This is about Brexit, and the question is, can you still pay customs duty on entry and declare import VAT under postponed accounting? So I think this is a question about you're paying your VAT in one place and your customs duty in another.
I think that's a good question, and I think as far as I can see from the guidance, the answer is yes. You'll be able to defer your VAT under postponed accounting, and you'll still be able to defer your duty element via a duty deferment account if you've got one. Certainly the guidance released by HMRC, which there's lots of it, and I did read most of it in preparation for this seminar, and there are three basic different types of customs declarations, and I would advise businesses that are going to be trading with the EU, imports and exports, after the 1st of January to look at that guidance and determine which are the best form of declarations to make standard, simplified, or deferred after the 1st of January, because there's a lot of guidance and it's not that straightforward. And yesterday's announcement on postponed VAT accounting was particularly welcome, I think, that most businesses are going to be able to benefit from that. And I think many businesses will also benefit from deferred duty accounting, using duty deferred accounts after January next year. But I would, the document referred to in the presentation, the Border with the European Union, which was out a couple of weeks ago, is certainly worth a look on this. And there is lots and lots of other guidance. Particularly helpful is it's a 10-page document called How to Import Goods from the EU into GB from January 2021, and it runs through importing goods through declared declarations, importing goods through standard import procedures, and importing a simplified declaration procedure. It runs through each of those 3 different methods. I would encourage people to look at that to determine their best position post-January.
Okay, thank you. I think we've got time for just one more question, and it's another one for you, Pete. So the question is the tax point for hotels the day of booking or the date of the stay?
So this was referred to in the presentation. You have a basic tax point, which is when the customer books the stay. Okay, so that's when your basic tax point is. And then you have an actual tax point, which is when the service is actually performed. So when the customer actually stays, for instance, in the hotel, physically stays in it. And what the rate of change provisions state is that if you had a pre-booking and received payment or issued an invoice for a booking prior to the rate change, so you had a basic tax point prior to the rate change, but the customer isn't actually staying, the service isn't being performed, there isn't an actual tax point until after the rate change, but crucially before the 12th of January when it goes back to 20%, then you can apply the 5% VAT rate, and that is the benefit of the change of rate provisions. Are particularly useful in that second category, of hotels and holiday accommodation, particularly helpful in that sector, and are designed to cover just that sort of scenario where you've got a basic tax point when the booking takes place before the rate cut, and an actual tax point that takes place after the rate cut at 5%. I hope that answers the question.
Okay, well, thanks very much, Pete. We've had loads of questions today, so for those that we haven't managed to get to this afternoon, we'll come back to you via email as soon as we can. So just to finish off, that's the end of today's webinar. So thank you very much for joining us and for asking your questions. If you'd like to join more RSM webinars and events, you can sign up on our preference page, which you can find on our website. It's at www.rsmuk.com/preferences. So just put your details on there and we will email you with details of the next webinar. So that concludes the webinar for today. Thank you very much, everyone, and we'll talk to you again soon.